Glenn Silverman, the CIO of Investment Solutions, joins us now for Investment 360. And of course, still with us on the desk is Wayne McCurry from Momentum Asset Management. Glenn, welcome to the program. Thank you so much for joining us. We're talking on the health of the asset management industry within South Africa. And I'm so glad to see that the ETF market hasn't actually cannibalized asset managers in South Africa. I know that there was a trend for some time after the recession hit.
And I think there's a need for passive, and I think there's a need for active. My time was spent here with the active managers in the main, although some of them do run passive products. And I found an industry in good health.
Okay, so give us a little bit more detail in terms of what you've actually been seeing. So active managers, very much in vogue right now, doing quite well in South Africa. We're starting to see returns also coming through. I mean, is there a direct correlation from what we see with regards to returns and also the health within the asset management industry?
So we spend a lot of time with managers. We've just spent a week in London seeing 20, and we'll talk about them the next time I'm invited to the show. But the 2 weeks before that was in Cape Town. Actually, the contrast between the two was quite stark. I think South African managers in particularly good shape. We've had a 10-year bull market. It certainly helps. But they were brimming with ideas and confidence and new products, and there was always some profit line that somebody else hadn't thought about that they thought was exciting, etc. And I think, sure, the bull market helps. But this is an asset management industry, brimming with confidence about the future.
Then do you see the number of players increasing or decreasing? What's been the tendency over the last year?
So we've definitely seen the numbers increasing. I think those managers get to a certain size beyond which they have to break. And when they do break beyond that, it can be quite explosive. The best example I can think of is Giokos. A manager that for 10 years really didn't seem to do very much and then went into this J curve and has gone exponential. So we see assets doubling, redoubling. They sit at almost 40 billion rand. This was a small asset manager just a few years ago. So I think there are a few that are at that smaller mark that may still need to break through the 2-3 billion mark. That seems to be quite a critical level. We notice in the small manager space. Some of them can make money at that space as well. But you need to be a bit bigger than that really to be, I think, sustained and substantial.
And other than investment returns, is the pie growing, or is it just a redistribution of assets? Ignore investment return. Is the actual underlying pie growing?
So you're talking about liquidity within the market?
No. The savings industry,
growth.
the asset growth, the savings industry.
Well, my strongest take from this is massive growth, and I don't know exactly where it's coming from. Massive growth. So I'm talking about managers who are all talking, for example, the retail market of getting significant inflows. We met a single manager out of 15 who said, okay, they were having a tough time, but the other 14 were all seeing strong inflows. Many of them got different distribution models and playing to different parts of the market, but clearly the man in the street, one, has a lot of money and two, is investing it.
This is this is very different to what we hear from the savings side of things, that South Africans are not saving. Debt to, the household debt scenario is still not playing out to the extent that we'd like it to. So again, as Wayne says, where do you think this money is actually coming from? And if we could actually speculate, we hope they're not lending to invest, obviously.
No, I don't think that's what's happening. Look, I think there may be some industry rotation, and maybe the life companies might be losing it to the more independents. I think that has been a trend, of the years, and that could continue. But it was something much stronger than I met with Deanne Gordon, who's one of the strategists of one of the houses who had done this review of the industry, and she said there's no money there. And I said, well, look, something's very confusing to me because every single asset manager, and they showed me the gross and net flows. And I'm not talking about the gross flows, because often you have a lot of money in and a lot of money out. I'm talking net flows, and the numbers were very big and very substantial, and we think we need to spend more time in the retail market.
Okay, in the retail market, is this now going to be your focus as well?
Well, it has been, and it's everyone's focus. Every asset manager has a strategy related to retail. They have to have it. It was the one common thread through every single manager, big or small, that they have to focus on the retail market because of legislative change, because of pension fund reform, because of the asset flows that are there. But I haven't yet found that manager, and maybe I just got to look a bit harder, or managers that are losing the money in any substantial way. There seems to be a savings of money. And where that money is coming from exactly, I'm not sure, but it's a good sign.
Now we'll look at, and
I hope you're seeing new money flowing in as well, Wayne.
In the retail side, there is. It actually has been quite strong. A lot of it into the lower risk type of product, the cash in the bond product, etc. But when you look at first rand results, or all the banking results, they're not losing deposits. So people aren't pulling money from the bank to stick into the retail unit trust industry at all. Glenn, has there been any major shift in, let's call it risk for want of a better word, in other words, asset allocation? Are managers now feeling a bit happier and upping their equity exposures, taking a bit of money out of cash? And that's the first question. The second question, very specifically, have chaps pulled money back from overseas because overseas investments have been poor for 10 years, extremely poor for 10 years in comparison to South African investments.
So again, remember that I'm speaking to these institutional asset managers, what's happening at the underlying, their client level, I can't say, but I would say no to both of those. In other words, firstly, managers are taking more money overseas, and secondly, I get a sense they're taking a little bit more money out of equities locally because they run hard. So I'm actually very proud of that. I'm very delighted to hear that, because you say if equities have been a 10-year bull market and arguably are slightly more expensive than they were 10 years ago, you would think that they should be taking some money, and they're doing that.
So they're not just chasing it.
So I think they're not chasing it.
And where's this money then going? Where's it going to? I mean,
a lot of it's going overseas. I mean, the guys are immediately going to the maximum overseas. Clearly, we've had quite a bit of a strengthening in the rand, and that might open a bit more capacity to actually take some money overseas. But when they're comparing, and they give us practical examples share by share, I think Wayne does the same thing, of companies listed internationally versus here, they find many bigger, more solid companies trading at significant discounts.
Is this the right approach to take? Is there a fear of risk of things going wrong once again on a global level?
Well, I mean, I think that fear is always there. We're not having the bull versus bear debate here, but I think at the end of the day, they're just saying quite simply, if I'm going to hold an equity, which I want to, I'd rather hold this much wider array that I have international of cheaper equities, better quality, with a very strong balance sheet, selling into emerging markets than necessarily South African ones with possibly less growth and more expensive.
So from a cost perspective, what are asset managers doing at this point?
So it's interesting. I think those that are growing very strongly can afford to spend money, and you're talking about their own internal cost they're hiring strongly still, but there are some that I think are seeing some kind of maturity in their business, and there was a definite discussion about cost control, wanting to see some of the benefits of scale coming through. So it's time to stop hiring more people. You want to actually see the benefit of the assets flow to the bottom line.
And what are they charging to clients? So total expense ratios, what kind of average are we seeing in the market?
You're asking this to Wayne, or you're asking this to me?
Yes, Wayne, tell us about
it's so massively dependent on product. But let me answer the question for you. If you are 8 out of 10 managers are simplistically put in the same pot, there's nothing that hugely differentiates you on performance over time or process or anything. We're all charging the same. So if it's a general equity unit trust, what will it be? About 1.5% a year, 2% a year. So you can't differentiate yourself. But the other 20%, the really top managers who have, through history and through past performances, really stand out, they charge a lot more because they get a performance fee on the assets that they manage. So those chaps are charging.
And that has really changed even
more.
through the crisis. We still had that remaining the same.
And of course, you can argue that everyone's fee should be performance related, because then you only pay your manager if your manager beats the target that you set the manager. So, I've got no problems with performance.
Also interesting to note, interested to find out with regards to value managers, growth managers, are we starting to see any specific trend in the market, or is it very diversified?
So I think there's been a very strong trend in the market, and it's driven by success. So the likes of Allen Gray and Coronation have been so successful for so long that every new startup manager we speak to wants to be one of them, and ends up with this kind of value tilt and this value philosophy, etc. So there definitely is a bias that way. We find very few strict growth momentum type managers, although within the South African market, which I think has a strong value tilt, I think the foreigners are slightly different. The foreigners like the thematic plays. They've all come in for our retailers. We speak to our managers, most of whom think the retail and consumer shares are expensive, but the foreigners hold 50, 60, 70, and sometimes more than % in those companies. So I think we're finding momentum thematic driven there, where you're happy to buy something that's expensive but running, and the story's a good one. And this is not a South African story, it's an emerging market story. We went to London, they talk the same thing. They want to buy into this emerging consumer in the emerging markets.
So let's just also touch on how foreigners actually get exposure to South African stocks.
Yeah.
Are they buying specific funds within South Africa?
No,
are they buying international funds?
They just come buy the shares. Yes, in other words, the foreign client puts their money into a foreign fund in New York or London or wherever, and then they just come here and they buy the shares. And they may be starting to sniff a bit at the banks now, but there's only been one game in town, and that's been the retailers.
Yeah, no, I'd agree with that. For the foreigners, I think that's been the game. And for most of the local guys, we said we'll avoid that game and play all the others. So they've been much more diversified. Wayne spoke a little bit earlier about managers looking very similar. When I start to look at the product ranges, I think there they're differentiating themselves a lot again. Some in fixed income, some in fixed income credit, some in alternatives, some in Africa, some
any
in
new
global.
products that we're actually seeing? You mentioned that
I wouldn't say brand new products in the sense that you've never heard of the product before, but each house is launching a new product. I mean, products proliferation does continue.